Gold has always been the quiet heartbeat of fear and faith. When trust in paper falters, gold glows brighter. And right now, it's glowing in pulses, surging, sinking, rising again. The world's oldest asset is behaving like it's alive, moving with every political headline, every rate cut rumor, every whisper of war. One day it's racing upward, the next it's dipping sharply, leaving traders dizzy. What's driving this chaos? A storm of trade tensions, economic anxiety, and central bank decisions, all colliding at once. The result isn't just a price rally, it's a global mood swing, written in gold. Gold doesn't pay interest, it doesn't innovate, it doesn't change. Yet it keeps pulling the world attention because it represents something modern. Money doesn't. Permanence. When everything else feels unstable, people run back to the metal that's outlived empires. But lately, even gold isn't steady. It's volatile, unpredictable, and emotional, reacting to every move made by markets and governments. This isn't a simple boom. It's a tug-of-war between fear and hope, between what investors believe and what they're scared to admit. So why now? Why this sudden burst of energy from a metal that usually moves like a glacier? The story starts with the world's growing unease. Inflation might be cooling, but growth is too. Trade routes are tangled. Technology wars are spreading. Currencies are swinging like pendulums. All of it adds up to one thing: uncertainty. In uncertain times, gold becomes a kind of global insurance policy. It doesn't rely on earnings reports or policy speeches. It just sits there, holding value when trust erodes. Central banks, especially in Asia and the Middle East, have been quietly buying it for years. Those steady inflows built the floor under prices long before this rally even began. But once the headlines turned darker, once trade wars resurfaced and economies showed cracks, the quiet flow of money turned into a rush. Investors moved funds out of risk assets and into anything that felt safe: bonds, the dollar, and above all, gold. And that's when the mood flipped from calm accumulation to panic buying. The new trade war rumors poured gasoline on the fire. The latest round of US-China friction sent shockwaves through global supply chains. Companies feared shortages. Markets feared tariffs. Consumers feared prices rising again. Fear, as it often does, made people look for something that wouldn't break. But here's the twist. In this cycle, fear doesn't move in one direction. It ricochets. Every new statement, every trade threat, every temporary truce causes gold to jump or tumble. It's no longer just a safe haven. It's a mood barometer. It reacts not to what is happening, but to what people think might happen next. During trade standoffs, currencies often get pulled into the chaos. Each side tries to weaken its money to make exports cheaper. That ends up weakening confidence in currencies themselves. And when paper weakens, gold strengthens. Even if the metal stays the same, its reflection in money looks brighter. The fear doesn't stop with trade. There's another player in the game: the Federal Reserve. Every signal of a potential rate cut sends tremors through markets. The logic is simple. When interest rates fall, gold wins. Because suddenly, the cost of holding a non-yielding asset disappears. If savings and bonds pay next to nothing, gold looks like a smarter store of value. Investors have already priced in multiple cuts. Some expect them sooner rather than later. And every time the central bank hints that cuts are coming, gold jolts upward. Every time they hesitate, it dips again. The metal now moves in rhythm with the Federal Reserve's tone of voice. But there's another reason this rally feels different: speed. In the past, gold moved slowly, reacting to real-world shifts. Now it reacts to sentiment. Social media amplifies rumors in minutes. Algorithms trade headlines before humans even read them. That speed creates volatility. It makes every move sharper, every correction deeper. This is why gold, the symbol of stability, has turned volatile. It's caught between human fear and machine precision. Day traders ride its spikes. Long-term investors clutch it tighter. Everyone else just watches, wondering what the next headline will bring. Some analysts warn that the market looks stretched. Charts show overbought signals. Momentum funds and ETFs have poured in record cash. But these same analysts admit something else. It's hard to bet against fear. As long as uncertainty rules, gold has fuel. And fear is one resource the world never seems to run out of. Physical markets are also showing the strain. In Asia, refiners report longer delivery times. Premiums on gold bars are rising as demand outpaces supply. But the same traders warn that it's a fragile balance. If global sentiment turns brighter, even briefly, that demand could vanish overnight. It's a strange paradox. Gold rises because people fear crisis. But that rise itself can create new risks. Once prices move too high, fast money piles in, and when those traders cash out, they can cause sharp collapses. In recent weeks, wild intraday swings have left even veteran traders breathless. Some days, gold behaves more like tech stocks than a safe haven. That's the irony. The asset that's supposed to calm nerves is now the one raising heart rates. The volatility doesn't mean gold is broken. It means belief in stability is. The more people question the system, the more they grab for gold, and the more unstable its price becomes. So, what happens next? That depends on whether the world's problems get better or worse. If trade wars drag on, if the Fed keeps cutting, and if central banks keep buying, the rally could stretch further. But if talks resume, growth steadies, or inflation cools faster than expected, gold could fall just as dramatically as it rose. Corrections are part of every bull market. They shake out weak hands and reset momentum. But this time, even a small dip could feel massive. That's because so many traders have jumped in late, hoping to ride the next spike. If fear fades, they'll rush out just as quickly. And that's when prices plunge. Yet even if that happens, gold's long-term story remains the same. It doesn't depend on one cycle or 1 year. It's a mirror for trust, or the lack of it. Every government promise, every central bank speech, every data release gets tested against it. And the verdict right now is clear. The world is uneasy. Gold's turbulence isn't just a market move. It's a message. A message that people are nervous about what comes next. About inflation, trade, debt, politics, and policy. When the future feels unpredictable, they reach for something that feels timeless. It's why, even after every dip, gold bounces back. It's not only traders driving it. It's ordinary people, small investors, and nations hedging their futures. If this story helped you see the bigger picture, hit like so more people find it. Subscribe for clear human stories behind every market move.